Now let me explain to you in detail. See, the question from both the students are actually interconnected, and therefore I have chosen to answer them together. Let me start with the second question first about the PCR. Now first you have to understand, as I said earlier, in a normal trade of anything, the buyer and the seller may have opposite views. But that is not necessary in options trading. In options trading, both the buyer as well as the seller may have the same view but with different targets. We will see as we proceed how that happens. To understand that, we must first understand who are the buyers of the options and for what purpose they buy, and who are the sellers of the option and what is the reason for them selling the options. So on one side you have the option buyer and the other side you have the option sellers. Whether it is call option or put option, for both it is the same. Alright. Why, or rather who buys an option and who sells the options? See, buyer of the options are normally small traders, people like you and me. Generally, I am saying, not always. And who are the sellers? Generally, the sellers of options, whether call or put, they are big players, the big institutions who have got lot of money. Why is it so? Because you see, for buying options, you require a small money, a small premium. And small traders like you and me, we have got small pockets. Premium required is very less. There is no requirement of margin money when you are buying options. The risk is also very limited to the amount of premium that you pay. And you have no obligation. Once you have purchased an option, whether call or put, you are a free bird. Nobody is there to question you. So because of these reasons, small traders like you and me indulge in option buying. And who are the sellers? Why do they sell? Sellers sell because they have got deep pockets. For selling options, you require large money. And they have got deep pockets, so they indulge in option selling. And they also have big analytical data about the market. The big players, they are able to analyze the market in detail. They have that data. And they are willing to pay large margin money as required. They are also willing to take unlimited risk. They are also willing to take huge obligation. But they are smart people. They are not dumps. They are not fools. Why they are doing this? We will see. Alright. What is the intention? When a person buys an option, what is the intention? And while selling, what is the intention? See, when a person is buying option, a person is basically speculating. People want to make quick money. By indulging in option buying, they want to indulge in quick money. But the big players, they are not interested in quick money. They are interested in protecting their portfolio and protecting their trade. They aim at creating long-term wealth, not short-term money. Alright? They may seem to be taking unlimited risk as we see here, but in reality, they do not take any risk. We will see how. Let us see how it works. Let us say a stock is trading at 100 rupees. Rupees or reals, dollars, yen, don't bother about the currency. Just try to understand the concept. Alright? And the call option of that stock, which is trading at 100, the call option at a strike price of 110 is trading at 2 rupees. That means what? If the lot size is 1000, then by just paying 2000 rupees, you can purchase one lot of that call option. As easy as that. Why do small traders do it? First of all, because they are bullish. They think that the market or the price will go up and beyond 110. And if it goes beyond 110, they earn a jackpot. Alright? But if the price does not go beyond 110, then they don't mind losing that 2 rupees. Or if the lot size is say 1000, 2000 they will lose. They don't mind that. But if they if the price goes to say 120, then what happens? 10 rupees difference, 10 multiplied by 2 multiplied by the lot size. So 20,000 rupees they will gain, a big jackpot, just by investing 2,000 rupees. Alright. Now, why do big players or the big institutions sell the options? If the small players are buying, why are big people selling them? First of all, you see, the big players, they are holding that particular stock in their portfolio. If they are selling the call option of that stock, they may be holding large quantity, maybe millions of those stocks in their portfolio. They are also bullish. They are also thinking, or their analysis is also telling them that the price will go up. But their analysis is telling them it will go up, all right, but not beyond 110, not above 110. So what happens if the price does not go above 110? They will retain that premium of 2 rupees. They are happy doing that. Not just 2 rupees. If they have, sold 1000 lots with the lot size of 1000 each, they will be getting 2 million rupees in a few days. They are happy about it. But if the price of that stock goes above 110, if it goes above 110, then of course they will lose heavily on the options. They will lose a large amount. But they have got portfolio, they have got stocks in their portfolio. So while they will lose on the options, they will gain on the portfolio. So ultimately they have got nothing to lose. They are balanced. Who is losing, if at all? It is the small traders. Try and understand this. Alright. So what happens here? Both the buyer as well as the seller of the call option, both have got the same view, bullish. But the buyer is thinking that the price will go beyond 110. The seller is thinking, well, it will go up, but not beyond 110. Try and understand the difference. Let us take another example, a similar example of a put option. Alright, same stock trading at 100. The put at a strike of 90 is available at 2 rupees. So again, a small trader will sell that option, sell the put option. Why? Because he's bearish. He thinks that if the price goes below 90, he will earn a jackpot. And if it does not go below 90, he does not mind losing that small amount of 2000. The big players or the big institutions, here they are also bearish, but their analysis tells them that the price will go down, all right, but not below 90. And they have a strategy. If the price comes to 90 or below that, they actually want to purchase those stocks for their portfolio. They have done an analysis and they know that if it comes to 90, they want to buy in huge quantity. So now what happens? If the price does not come below 90, then the sellers of these put options, the big players, they are happy retaining that premium of 2 rupees or 2 million rupees, whatever. But if the price goes below 90, then they start losing on the option. But they have a strategy. What they'll do now, they start purchasing the stock in huge quantity. So when they purchase the stocks, the price again starts going up and it will come above 90. So the option for the buyer will expire worthless. These people will retain the premium as well as they have purchased a large quantity of stocks for their portfolio. See how smart they are. Here again, the buyer and the seller both have got a bearish view, but with different intentions. Now, try and understand this very carefully. Let us say at a given market level, whatever level X, maybe 25,000, 30,000, whatever. At a given particular level of the market, let us say that the puts are 1 million and calls are 2 million. That means the put call ratio is 0.5. Alright. Now PCR 0.5 mean the call trades are more than the put trades. That means double. And that means the market is more inclined towards the calls. That means a bullish sentiment. But for a trade to happen, there has to be a buyer and a seller, isn't it? Then only a trade will happen. So who are the buyers of the call options? They are generally small traders like you and me who believe that the market will go up above a level. And then who are the sellers of the call options? They are generally the big players, as I said, who believe that the market may go up but not above a particular level. See the conflict now? Alright. So while the sentiment remains bullish for both the buyers as well as the sellers of the call options, both are optimistic. The call sellers, who are the big players actually, they will not allow the market to go up beyond a point, because the sentiment is positive, all right, the markets may go up a bit, that is all right, but as soon as the market goes up, what happens? The call sellers, that means those big players, they will be in a loss on their option trades, isn't it? They are the call sellers. If the market goes up, they will be in a loss. But on the other hand, their portfolio is also rising. The portfolio is in profit. So what they'll do, they'll start selling their portfolio in the market, and the market will again come down. Got the point? Try and understand this. So very often you see OTM option buyers would notice that their trade suddenly gets into profit, a very good profit, and then again quickly comes back into a loss. The call option premium goes up and then suddenly comes down because the big players start selling their portfolio. So therefore, if call trades are more and the PCR is very low, that means that the market may be oversold and therefore may rise up due to short covering for a short time. But that does not mean that the market will go up further beyond a certain point. Alright, at the point where we have noticed the put call ratio. So I hope you understand why a put call ratio or a low put call ratio is not a bullish sign. Rather, it is a limiting sign. It is a limiting signal. It says that okay, the market may go up, but the market is not likely, or the price is not likely to go above that particular level. Alright, so I hope you understand this very